I did a Pentagon study, and it was produced in early 2009, and it explained how foreign interference had the potential to crash our stock market and thus change the election. Since then, multiple studies have demonstrated that the stock market's performance late in an election cycle is highly correlated with election outcomes. That's not news. That may be news to you, but it's not news to the Chinese Communist Party. And there are others who have the motive, the means, and the opportunity, plus the contacts to crash our market and thus alter the 2020 election. Don't think they do it? To the left, this is existential. They have to take back the White House. They're planning to do it. I'm certain of it. So what can we do about it? Well, let me tell you about an obscure rule. You probably never heard of it. But in 1937, the markets had bounced around during the 30s. And after a big drop in 1937, they formed the Securities and Exchange Commission. And it was supposed to protect investors and kind of halt this market manipulation. And they hired an interesting guy to be the first director of the SEC. His name was Joe Kennedy. Yeah, that Joe Kennedy, the father of John F. Kennedy, the president. That Joe Kennedy, who was accused of bootlegging and all kinds of things, and also market manipulation himself. I mean, who better to stop manipulation than somebody who's done it, I guess. And so they hired Joe Kennedy, and the first action he took was he put in something known as the Uptick rule. You ever heard that term, Uptick? Well, that's a great rule. It said that if you're short selling in the markets, like betting that the market's going to go down, that between trades, before you could enter a second trade to short sell again, you had to wait for an uptick. You had to let the stock go up one tick, which at the time was an eighth, just a little bit, but it had to be positive before you could proceed. So you couldn't just have this machine gun selling down. That's what he said the rule was to prevent that. Now, that was in place from 1937 to 2007. And the SEC did a small study, a 6-month study. It looked at a couple of thousand companies, and they removed the uptick rule on those companies. And they said, hey, guess what? The market didn't crash. It was no big deal. Now, there are a lot of people who understand the study they did was very flawed analysis. It was too short term. It was in a very calm period. It was only on a couple of thousand stocks. And it wasn't when somebody was trying to destroy our markets. But they did say, well, it had a very slight benefit. If the uptick rule was in place, those companies where the uptick rule was allowed, that did a little bit better than those where there was no uptick rule. So they said it doesn't have any meaningful effect, and they pulled it. Now, since then, there have been a lot of studies that dispute the findings of the SEC. They were flat out wrong. Nevertheless, the move to remove the uptick rule, the SEC pulled it off in 2007. And what happened in 2008? Yes, the biggest decline since the Great Depression, since 1937, biggest one in 70 years. Don't you think it would be a good idea to put it back? So the SEC studied it, and they decided, well, we'll put this rule back that says that every time the market drops 10%, then we'll say that you can't continue short selling. Stop a minute. That doesn't work. If it goes down 10% an hour or 10% a day, it still destroys our market and would change the election. It's still handing the keys to someone who wants to harm our market. So the new uptick rule doesn't work all that well. But the people who profit from high-frequency trading that run the computer algorithms, they make a fortune, and they want no uptick rule. So who's in favor of it? Well, I am. But there are other better-known market people like Jim Cramer, you know, the Mad Money guy. He says, put back the uptick rule. How about Charles Schwab? Ever heard of him? Charles Schwab wrote an op-ed, put back the old uptick rule. And there's a hedge fund guy named Leon Cooperman, who's brilliant, made a lot of money, and he says, put back the uptick rule. Putting it in place now would certainly stop any destabilization plans. So here's our recommended action. The Securities and Exchange Commission should immediately reinstitute the traditional uptick rule. This would prevent malicious manipulation or control of high-frequency trading designed to cause a market crash. The SEC should also require that all shares sold short must first be borrowed. No naked shorting allowed. We'll cover naked shorting in a future program, but I want you to understand those two actions would put a stop to the potential nefarious activity that a foreign power might use to control our election.